From the previous market peak of October 2021, the market capitalization-oriented benchmark indices have witnessed a price correction of 5% to 6%. During the same time period, the earnings growth of companies within these indices has been quite strong, ranging from 20% to 23%. Due to strong earnings growth, combined with a small drop in prices, the valuation, PE, for the indices has derated significantly by 20% to 25%. The silent crash in valuations provides a good opportunity to invest in the equity market in a staggered manner. Healthy earnings growth is a positive and should provide a cushion to valuations going forward. From the peak of October 18, 2021, the Nifty has corrected only around 5%. At the same time, the trailing 12-month profits have gone up 23%. Consequently, the valuation, which is the price-to-earning ratio, has derated by 23%. When we look at the top 1,000 companies, we find that the market cap from the peak has corrected by around 5%, whereas the profits have gone up by 24%. Consequently, valuations have become more attractive. When we look at the loss-making companies within the top 1,000, we find that their losses since the peak levels have reduced by almost 22%, which means that companies have likely become more efficient in managing costs. Earnings growth is likely to be steady for the next few years. As per the temperature gauge index, valuations are still in fair value zone. For incremental investments, we continue to suggest 50% deployment immediately, and 50% to be staggered over 3 to 6 months, while being able to accelerate deployment during sharp corrections. Based on trailing 12 months, Nifty 50 EPS, temperature gauge index, suggests that large cap valuations are still in fair zone. We maintain a bias towards multi-cap and select mid and small cap strategies across MF, PMS, and AIF platforms. On current account deficit, a combined average monthly deficit of $12 billion during the past 15 months, a reduction to $6.6 billion in December 2022 and further to just $4 billion in January 2023 is highly welcome. India's current account deficit will likely narrow to approximately 3% of GDP in the third quarter of financial year 23, further to about 2% of GDP in the fourth quarter of financial year 23. We expect it to remain at approximately 2% of GDP in financial year 24. Currently, the mid part of the yield curve is still steep, with a sweet spot between 3 to 5 years of maturity. On account of global and domestic factors like global central banks' policy actions, currency, inflation, crude oil and geopolitical events, yields may remain volatile with an upward bias. In such a scenario, we recommend to focus on accrual rather than duration, and the core allocation should be locked in at higher yields without taking extra interest rate and credit risk. Hence, for fixed income portfolios, we suggest core allocation to a 4 to 5 year maturity segment through high credit quality, target maturity debt funds, which invest in a combination of GSEC, state development loans, and AAA rated instruments. Tactical allocation to select high-yield strategies, REITs, and InvITs, can help enhance the yield on fixed income portfolios. Delphi, ASAP, is an all-weather strategy that benefits from asset class diversification and yearly rebalancing. It is positioned as a superior alternative to fixed income,